This podcast is intended and contains general information on financial strategies, investments, and products only. Whilst Luke and I are both licensed financial advisors, we don't know your personal circumstances, goals, or objectives. We highly recommend that you reach out to your financial advisor or investment professional to discuss any of the topics that we've covered today before taking any action. Our full disclosure, copies of our financial services guide, and additional information about Seneca Financial Solutions and Bold Wealth can be found in the show notes. G'day. Welcome to another episode of Wealth Toil. I'm here with my partner in finance, Luke Larrative. How are you, mate?
G'day, Dill. How are you, mate?
I'm good. What's going on in sunny Torquay?
Not a lot, my friend. Just working away, plugging away. Markets are generally behaving today, so been a busy week so far, and lots of little initiatives going on at Seneca, so keeping myself occupied.
You're featuring.
What about you? Any goss?
Featured on AusBiz a couple of weeks ago. I saw, mate. Very good. Just telling the people, giving the people what they want.
Yes. Feed them those stock tips. Force feed it to them. We did a bit of AusBiz and a bit of equity mates last week, and back on the Wealth and Toil grind now that you're out of your holiday mode.
Yeah, absolutely.
How was the little week off?
Yeah, a little week off up the wild west coast of Tasmania, spending some time in the mines, which you would have liked quite a lot. It's fairly wild up there. I can tell you. It's stunning. Absolutely stunning part of the world, though. If anybody ever gets a chance, highly recommend. But yeah, probably not the most profitable mines in Australia up there on the west coast of Tassie anymore. But yeah,
but it's a very, very picturesque part of the world. Very picturesque part of the world. So
dense
well worth the visit. I've been over there a little bit.
Yeah. No, you love.
And did you do much hiking, Dill? Any walks?
Yeah, we did. We did the walk to Montezuma Falls, so Tasmania's biggest waterfall. I think 111 meters, and because it's the west coast of Tassie, it had pissed with rain the night before, which we really enjoyed because we decided to do a camp of roughing it in the Deluxe King swag that we run, and yeah, it was. We
dead in that.
We woke up in a bit of a puddle. That's but that's all right. Fee enjoyed the night of roughing it so that we could go and stay in a nice little Airbnb, which was we certainly enjoyed the creature comforts of a kettle and a working stove the next night.
Today sounds like a lovely way to spend a week.
It was ripper, mate. It was really good. Always good to have a break, take advantage of the public holidays. Back to it, mate. And this week, I think we're going to follow on from our last episode a couple of weeks ago, before the boys from Equity Mates came and showed us how to run a real podcast. We're going to continue talking about retirement, but this time we're going to go a little bit more up your alleyway and talk about how and why building a retirement portfolio is, has its niches and has its differences to building perhaps an accumulation portfolio. Some things to consider when you're thinking about your retirement portfolio, and maybe a couple of tips as well. So we'll throw that in. You mentioned the markets before. What's going on? What's going on at the moment? China's had a rough month.
Yep, Chinese equities down 1.25% over the last week, and they're down 17.8% over the last 12 months. Have had a decent sort of quarter though. But that being said, they've still underperformed most of the other markets. Yeah, I was just going to say, locally we've had a pretty good little period, but slight sell-off this week with the ASX 200 down about 78 basis points. With industrials being the main source of selling, and the resources sector doing a little bit better, particularly on the back of a continued rally in the gold price. So
this is such an interesting week. It's such an interesting and exact thing, exact reason we want to talk about this, because with a lot of our retiree clients, and a lot of, I think, general retiree rhetoric is around the concept of these blue chip high dividend paying stocks being the only way in which you can build sustainable income in a retirement portfolio. And look, I love the fact that dividends are positive in Australia and we get good tax benefits from holding them, but it's not the only thing. And I think the example that you just gave around, Australian equities have had a sort of roughish week, but a good quarter. But compared to some of the rest of the world, those people that perhaps build their portfolios purely around one asset class are probably falling behind.
Yeah, definitely. If that asset class is just Australian equities, and in particular just sort of ASX 50 or 20, even top 20 type equities. Not that these haven't been decent performers over the longer run, and not that larger businesses operating in oligopolistic style market structures don't have their benefits. I just think that there are, the idea of a portfolio, regardless of the asset allocation, is to source income and growth or returns, let's just call it, in totality from a range of sources. And what I mean sources is not just from a range of companies, but you want from a range of styles of company, from a range of different types of industries. That's what true diversification is. It's not just owning everything. What it is distinctly sourcing those returns from a range of opportunities across the market and different styles of return that can maybe complement each other, in a range of market conditions. And that's what, in my view, is actual diversification. We get a bit caught up in just kind of spamming our portfolio, for lack of a better word, with different small, tiny, inconsequential investments, and this doesn't necessarily result in diversification.
No, for sure. And I mean, how often are you seeing? How often are you seeing clients that sort of come to you with a portfolio that they've built themselves, and like seeing a lot of the same stuff in it? So I know that I could without naming several people, but I hope that these clients maybe listen to this one day and think of themselves. No. Absolutely, absolutely not. But I've had a number of people who've come to me and received significant investments in the banks when they listed. Might have then diversified into some of the big miners over the times and basically shown me a portfolio that of 7 of the top 10 stocks. And it's not uncommon. But the willingness to divest, I find, is quite an interesting, the willingness to go away from these blue chip stocks that they feel have done very well over that time. It's quite a challenge.
Yeah, I think a lot of investors are really good at buying, but investing is a two-sided coin. It's also selling, and that's how you make those investments real. I think also people don't hold investments to the same standards like they should. So, say for example, I recommend a portfolio of BHP, CBA, and other blue chip stocks. You pick the names, but as long as that goes up over 5 or 10 years, the client will be happy, regardless of how much it outperforms or underperforms a benchmark. By the same token, if I bought a portfolio of 20 to 40 companies that didn't include names they know, because for whatever reason they weren't familiar with them, that would have to beat the benchmark after fees. So I think there's a familiarity, there's a comfort with doing things that they feel like are normal, they feel like are common, they feel like are what everybody does. And I think in that familiarity is the risk. And the risk is that your opportunity cost, you could be investing in better things that might improve your lifestyle or help you meet your goals faster and more completely. And you're also ignoring, I suppose, some of the benefits we get from diversification, which, as somebody famous who I can't recall once said, there's the only free lunch in finance.
Wasn't it your mate Warren or his mate.
It might have been Charlie. Might have been Charlie Munger,
Yeah, it
but
might have
look,
been
I
Charlie.
wasn't confident enough to. Wasn't confident enough to run with the official quote. But
fact check.
You get
Luke will give you a free portfolio review if you email into the podcast. Speaking to the millions of listeners that will one day listen to this, Luke's up for a free portfolio review on that.
Yeah.
One of the things on that though, like familiarity for retirees is really important, right? Like familiarity in understanding what they're invested in. Like that is an important factor because this is now for a lot of people their only asset, right? Outside of maybe their house, it is the thing that's giving them their bread and butter every morning. It's giving them their ability to
paying their wages.
That's right. It's paying their wages. And, familiarity, knowing some of the names of the companies is really important. How do you generally overcome that with your clients? Like making sure that they are comfortable with maybe some lesser known stuff.
Yeah, I think the key is, people don't buy investment codes or even historical returns. I think you need to have a story. You need to have people. You need to explain it in a way that makes sense to people. And I think that's what I try and do and spend a lot of time doing is really having a granular understanding of the investments that we make. And that allows me to sort of explain them in simple terms. I think the skill of being a professional who provides advice in any industry is to ideally take complex and sometimes convoluted ideas and be able to express them in a clear, simple, and concise way. And I think that's one of the key skills of a good advisor is to be able to really have a comprehensive understanding of things, and that allows you to explain things in a common sense way. I mean, I use lemonade stands are like the most common business that I talk about. And I can almost explain any concept in finance or personal finance using a lemonade stand analogy.
Oh,
so
feel
free to test me on that.
Yeah, absolutely. I'm going to ask you later on. Can you explain?
We can do it today. We'll do it on dividends today.
Absolutely. So, like thinking about that approach, right? Like, obviously, the trust is so important. The other thing I often say to people is like, if you just want to go and buy the banks and you're pretty confident in that as a strategy, then like 100%, like go and do it. But a lot of the things that come with retirement planning, I think, are more around some of the behavioural elements. What happens when a market drop of 20% happens? Do you keep your bank shares, or do you ride that out? What happens if the banks reduce their dividends by half because they're not making the same margin? Now, is that your only income source? Like, how do you change behaviors as somebody who holds these stocks? Well, capital growth, very important in retirement portfolios as well as income. And I think that's often missed. Right? So,
yeah, I think the most important thing here is people spend a lot of time wasting their time thinking they're doing rubbish analysis. So looking at the historical dividend yield of any stock tells you that what that company's been able to pay historically relative to the price today. It's not actually a very relevant ratio. And you could say the same thing of historical earnings. It doesn't tell you a lot. So, focusing on forecast, focusing on trend, focusing on rates of change, when we look at whether it's a dividend yield, a PE valuation, or any other metric to do with the business, to be honest, is far more important than a historical yield. And I think people often get caught up in, if I just buy a company that's trading on a 10% dividend yield, I'm happy with a 10% return. Well, you won't be happy with a 10% return when at the end of the year your shares are worth 15% less than what you paid for them. And the stock's now trading on a 15% dividend yield, and you could have either A, had a 15% yield, or B, had a much better investment somewhere else in totality. So
but also,
I think
on that,
we need to
if the
put that in
client,
perspective.
yeah, I mean, also on that, if the client then has a 10% dividend yield ongoing, but that company is dropping in value by 15%, eventually their 10% dividend yield is going to be worth less and less and less. It's very rare that a company whose value
100%.
falls increases their dividend yield every year. That doesn't happen, right? If they're paying out more and more of their cash,
and
they're going to have less to invest in themselves.
100% do, and this is where my lemonade stand example comes into its own. But if you and I are running the lemonade stand, and we make $100 profit,
what are we doing to the lemonade
for the day?
What's our point of difference? A little bit of cayenne pepper.
We'll get on to the point of difference down the road. But let's just pretend we've made $100 profit, and let's say we are paying out 100% of our earnings in dividends. Well, that's fantastic, but we now don't have any money to buy lemons tomorrow to make our lemonade. So, if you've got a business that is paying out all of its profits and got no money left over to buy inventory the following day, next year there's going to be no dividend. And by the same token, if you've got a business that generates a $100 profit and goes out and spends another $100 on lemons tomorrow, in year 2 they might sell $200 or $300 worth of lemonade because they've now been able to invest in inventory. So I think understanding where dividends come from, in that it comes from company profits, and that the sustainability of those profits and subsequently the dividend is really what we need to be focused on as investors. And like you said, Dill, if the share price starts to go down and it turns out to be a bad investment, you're going to have not only being under rewarded from a dividends perspective, those dividends are going to start to probably go down in line with the company profits, because that's a fantastic, axiom to base all of your investments on. Share price follows earnings or profits. And so if if you're buying a business that maybe is paying too much in dividends and not investing enough in the business, or doesn't have any other alternatives except to return cash to shareholders because the returns in that sector are in the decline, as it is in the banking sector, ironically, it is going to be a difficult situation to be in, because you're going to have declining dividends and declining share price. And if you go by your previous comments, there's going to be a share they're not willing to sell on a dividend yield that's declining every year with an increase in capital loss. And it's not a very nice position to be in.
No, it's certainly not a sustainable retirement model. I mean, we talk about this a lot with all our clients who are in drawdown phase, right? Like if you continue to, or if you start drawing down more than what you're earning, your balance is going to go down. And if you continue to take the same percentage out, and that is greater than your percentage return, you will eventually get to a point where you are unable to continue to draw that income. So having that sustainable retirement strategy is really important. And that's where we use, look, the traditional balanced 60-40 portfolio, it's probably been talked to death, but there is a lot of merit in having a defensive allocation in retirement.
Definitely.
Some of the things we use, we obviously use fixed interest. So we use fixed interest managed funds. Big part of what we use, if we can get them, high interest savings and term deposit type accounts. And then the other thing we use is fixed term and lifetime based annuities. So where we've got a bit of a guaranteed allocation of income with the potential sort of cashback in the event of it being necessary on some of those on the capital invested. So what I guess I'm speaking about there is...
I think you hit on a good point there.
No, you go.
I was just going to say, I think you've hit on a good point there, and that is that you can source. It's not about sourcing necessarily the highest possible return on every portion of your portfolio. Sometimes parts of the portfolio are used to ensure your lifestyle. Other parts of the portfolio are used to ensure your future, and some parts of the portfolio, if you're fortunate enough to have more money than you need, are going to be used to help ensure your children and your future legacies lifestyle, for lack of a better word. So I'm big on making sure that retirees are thinking about, okay, if I can afford to live off the income that's produced from an investment, how can I ensure that if that income was to ever go away, be impacted, I've got enough cash there to be able to maintain my lifestyle through that cyclical downturn. I'll try that for the third time, and similarly, take advantage of that potentially to then further your income down the road. So it's important to look at cash. It's important to think about annuity. It's important to think about the investment time horizon and map that investment time horizon, like every good treasury department does for every major company in Australia, to the liquidity requirements of that particular entity, or in our case, family.
Yeah, no, the family stuff's so important. I mean, we've talked on here before, but you and I talk about this a lot with pretty much every client we deal with, and that's making sure that people are considering their legacy whilst also considering their lifestyle. Too often, our retiree clients don't spend anywhere near enough of their retirement funds. And we're constantly having meetings with them saying, no, go on that holiday. Like, book the 5-star hotel, because you spent 60 years of your life accumulating this wealth, and you should use it. The other thing that we talk about is making sure that you can give to your kids. If you're planning on leaving an inheritance, think about giving to your kids whilst they're still alive, so you can enjoy seeing them enjoy.
I hope they're still alive. You mean you're still alive?
That's what I mean. Yeah. But give to them whilst you're still alive, right? Like if your house is paid off and you've got more money than what you need to live off for the remainder of your life, consider helping your kids pay off their mortgage now, so that they can then think about sending their kids to private school without having financial stress, or so that they can enjoy family holidays in the same way that you will be able to provide for them. Got too many clients in the accumulation bucket who struggle based on the cost of living, and too many people in the retiree bucket who are probably not spending and holding a lot of their money in defensive assets that are only going to pass on to the future generation, when that money could be more effectively invested by the accumulator over that same time, and the net family wealth could be much bigger.
Dill, can you tell me, can I ask you another question, or ask you a question about, tax as people transition into retirement? It's a big concern. I just had a meeting today with a 60-year-old couple in Perth, and they're not quite sure, what their entitlements are, or what they can do to minimise tax. Aside from your basic sort of $30,000, $27,500 this year and $30,000 a year next year contributions to super, what are some of the main things that people can keep an eye out for, and definitely ask a question of their financial advisor? Hopefully that's you or I, as they sort of get to that retirement age.
I think you sort of hit the nail on the head. At that point in their 60s, utilising the concessional superannuation contribution caps is going to be their biggest their biggest friend. Hopefully, they've been putting in the maximums for a longer period of time. But if they haven't, there's multiple years where you can use what are called catch-up contributions. So using catch-up contributions means that you can go back up to 5 years and use whatever the amounts that you haven't put in to super from those years, and bring them forward and make significant lump sums, or even just do it on a year-by-year basis. So as an example, if in the 2018-19 financial year, these people they would have been 55 at the time, these people only put 10 grand into super, that means that this year they can put their 27.5 in, but they can also put in an extra 15,000, and that's a tax deduction in their personal name. The reason that these contributions are so important,
which while you're still working, if you're a high income, which while you're still working, if you're a high income person, is great.
Absolutely. I mean, if you're high enough income at that point, you're probably maximising the cap anyway, and you have been previously. But where it comes into its own is particularly where clients are in that transition to retirement phase, and they want to realize some of their long-held capital growth assets, because we can then take that, offset the capital gain using potentially significant amounts of superannuation contribution, meaning they don't have a tax burden on those on that money, on the capital gain that they've made from a long-held investment. So by doing that, they're actually then, like by doing that, they're able to use potentially, 50, 60, some cases even 70. And if you've got a non-working member of the couple and they haven't put any contributions in, a good example might be an investment property that's been held in joint names being sold. Well, half the capital gain is going to go to a non-working member of the couple, and then you can put up to $130,000 into superannuation to offset capital gain on that and be only taxed at 15%, as opposed to an average marginal rate of perhaps 30, perhaps even more. So that's a really good strategy. Yeah. One of the things that the other thing that's really important as well is being able to draw from age 60 a tax-free income from your superannuation. So if you're not in the stage where you've got assets that you need to get into super at that point, you can actually draw some money out tax-free from super each year and then put money back in and claim a tax deduction. Reduces your average marginal tax rate. And from 60 onwards, it's a pretty good way to add another 50 or 60 grand to your superannuation fund in most cases.
Free kick.
Absolutely.
Little free kick for the retiring boomers. Dill, could you talk about one, I'm going to get off the tax stuff, and I wanted to ask you around the investment side. Now, I know you've got some fairly strong views around people getting too obsessed with income investing in super and in retirement phase.
Yeah.
Can you just maybe outline your basic thesis here? And I'll step in on behalf of the boomers and whack you when required. But if you could just outline your thesis, please.
All right. So investment thesis, just please refer to the show notes for my 600-page white paper on retirement income that doesn't exist. But no, one of the key sort of parts of this thesis, as Luke's called it, is the fact that once we're in retirement, our accumulation funds that are held within superannuation, so up to that 1.9 million transfer balance cap, that can be put into an allocated pension where earnings and capital gains are 0% taxed. So earnings being dividends and income from assets is 0% tax, but also there is zero tax on capital gain. So you can hold an asset, it can double in value, you can sell it, and you are not taxed within that allocated pension environment. Now, that's really beautiful because it means that we no longer have to favour those Australian franked dividend paying companies. We can actually just look for what is the best total return. It allows us to have greater diversification. Asset allocation becomes much, much more important. And it also means that our income-paying defensive assets are paying a true return on investment, what they say on the ticket. Might be a 4 or 5% deposit cash account, because we're not losing that to tax. It all comes back to tax.
So you're saying your essential argument is, and look, I don't disagree for the record, but the principle is, and the principle for retirees to think about is you are no longer, your marginal tax rate is now 0, and as a result, you should just be chasing as always, the highest after-tax return. However,
That's
there
right.
is no mystery franking credit benefit to you, and certainly that you should no longer differentiate between a capital gain or a dividend or other distribution and income.
Yeah,
gain,
I mean, there's still a benefit
word.
from the franking credits, because if you're in a 0% environment, you're going to get the full 30% that's already been paid from the company. You're going to get that back within the pension environment. So income producing investments are good, but again, if you look at capital growth over the last 50 years in markets versus the income over the last 50 years in markets, capital growth has been, almost 12% a year on year in an accumulation index. Income franked is about 4.5, and that's in Australia. So,
yeah, I think still comes back to our lemonade stand example of, if we think about, you're talking about in aggregate here, and I'll sort of chime in there and say, you look at average share market returns around the world, you're looking at a high single digit number depending on the time period you're looking at on average. So you're getting great returns, 8s, maybe 9s and 10s if you're talking about the US or a US heavy index. Now, that being said, the Australian index has been generating about a 7.5-8% return as well, of which, as you say, is 4% is roughly from dividends, and 4% historically has been from capital growth. However, the reason why we've underperformed, and there's lots of actual reasons, but a back of the envelope.
Let's talk about the ones that don't exist.
Example would be. Well, let's talk about the ones that don't exist in the sense that we've got a business. We got businesses in the US that take $100 of their lemonade profits from Monday and reinvest it in inventory to sell more on Tuesday. The companies in Australia take $100 of profit and they take 50 and take it down the pub and buy a round of beers, and with the other 50 they go and buy inventory tomorrow. After 10 years of compounding, which one do you think is going to have a more valuable business?
I
rest my case.
I love the concept that in Australia we've got literally, Matt Common from CBA looking at the financial results going, cool, $50 for you, and that's $50 for the pub for the boys.
Well, if you're Matt Common, it's probably more. I think his payout ratio is close to 80%, right?
Yeah,
so the
sweet.
The reality is that it doesn't mean you don't have a sustainable business model. Let's not go back into that conversation we had before. What it does mean though is that if you're not reinvesting, you can't expect higher rates of return. This applies to companies. It applies to retirees in retirement who try and benchmark themselves to the ASX 200 All Ordinary or some accumulation index when in fact they are no longer reinvesting their dividends. In fact, they're withdrawing their dividends. Mm-hmm. So you need to be comparing it to a different sort of benchmark. I think that, and certainly, if we're looking at global equity returns, companies in the US or the US indices, which would have dividend yields in the high 1% range, 1 or 2%, those sort of indices are going to be taking 90% of the earnings and reinvesting it at rates of return that are much higher than cash. And so as a result, they've generated better returns over time. And as a retiree, you can benefit from those better returns. And as I always say to people, you can replicate a dividend, any dividend yield you like. It's very simple, and this is what I would recommend to almost any retiree. Excuse me while I adjust my light, which seems to be falling over. And that is by doing this. Invest in your ideal investment portfolio that generates the highest possible total return for you. That will have some dividends and some growth. Of the dividends, as you receive the cash for those dividends, immediately reinvest and get that money working for you again at the highest possible rates of return. And at the end of the year, you'll know exactly how much income you've received and how much growth you've had. Now, there's nothing stopping you from ripping out the equivalent value of the income and using that to live on for the next 12 months. And then you would not have touched the capital, but instead you would have compounded that capital for the period of the year, maximizing your total returns, maximizing the value of compounding for the course of the year, and still maintaining a dividend yield for yourself at the end of the year. This works well also with monthly withdrawals. Sometimes sometimes from income and sometimes from growth. It makes no difference, except for in costs, which you need to be aware of. But at Seneca, we don't have the brokerage on platform, as deal is negligible.
Yeah, I mean, one thing we do a lot is we talk about the different sectors of people's portfolios. So we'll have we'll have a maybe 2 to 5% cash allocation, which is where people are drawing regular income from. We'll then have maybe a between 20 and 50% allocation to those defensive income paying investments. Now, they can either be reinvested into their aggressive portfolio, or they can be additional cash top ups. And then we have the aggressive portfolio, which we don't buy down from. The way we build that out is that clients who are in that retirement phase are basically taking their income from their income producing assets, and they are generally wanting to pass on to the next generation a asset that has had high growth over that time. Now, that retiree can use a 0% tax environment to grow wealth for their next generation and only draw on the income from their income producing assets if everything is set up the right way. So, I mean, it comes back to asset allocation and things that are fit for purpose. But if you've got some pretty well-defined defensive allocations in the portfolio that are going to give you enough to live off, and potentially you draw down on that capital, which, has a lot more security, it does allow you to be a bit more aggressive with the remainder of your portfolio. But you have to recognize and have things set up in a way where you're not pulling out of some of those aggressive things that might drop by 20 or 30% in a bad year, but on another year might be going up by 20 or 30% each year. We really want to make sure that that's compounding at the rate that it's designed to do. Regularly review it, of course, and make sure that you've got appropriate allocations. But, this is where portfolio construction really actually makes a difference. I think it's retirement and larger accumulation balances getting toward that stage.
Dill, I look at fixed income now, and we run two income products at Seneca. We run the Seneca Aggressive Income portfolio, which invests in investment grade and sub-investment grade bonds, hybrids, and up to 30% of income producing or income focused equities. Think sort of infrastructure and property style investments, as well as some private credit opportunities. And we also run a defensive income portfolio, which only invests in investment grade bonds. So they're two sort of distinct risk profiles. And I think, those portfolios now are yielding over 7 and over 9% forward running yield. And, so I don't really understand. You don't have to take, in a 2024 world, you don't have to take equity market risk to generate high single digit returns. You can actually lend money at, A rated or triple B minus rated levels and generate 7s and have much more capital certainty, lending money to some of the biggest and best businesses around the world. You don't need to be chasing these equity returns. What do if you've got a client, they come in, they've been in equities for a long time, how do you talk to them about saying, hey, to get what you want, which is capital preservation and a really good income, how do you actually talk to them about bonds? Because I know my retiree clients, they struggle. They don't understand bonds. They can't price them. They can't see them on the Yahoo Finance. It all gets a bit confusing.
I think the main way is we have a drawdown illustrator to show what that looks like. And what we do is we point out different points in the market where equities have fallen by a significant amount and the effect of taking drawdowns out from those equities at a time of market drops. So that is one really clear way of going, cool, this is what happened to bonds at that time, or this is what happened to fixed interest based securities at that time, and this is what happened to equities. The effect of taking money out of the market, which is what you're doing in retirement,
making a mistake.
Right. Taking money out from those assets in retirement when the market drops, which it does on occasion, has a much, much more significant impact on your overall balance longevity. And so that's why we design portfolios that have those income producing assets, and moving people between them in an environment where there's not significant amounts of capital gain outcome. Yeah, the one thing that we might do that's slightly different is we use sort of certain lifetime based assets where clients are effectively giving up putting forward an amount of their capital that they're not expecting to get back in order for there to be a much greater than what the current fixed interest rate return would be. But that's generally guaranteed beyond life expectancy. And it's based on an initial capital deposit, but you can basically put that in there and say, hey, here's $100,000, or let's use that as a round number, $100,000. Our expected return on that is 7.5 a year in income for every 100 grand we put in, plus CPI ongoing for the rest of their life. Now, there's a little bit of betting in there, right? Like if you're really unhealthy, yes, there's a death benefit associated and you get some of that capital back. But if you don't last beyond a certain point, then you've probably lost that game. But if people are living longer as they are, generally what we see is that those assets outperform and they have 100% certainty of providing that income. If you combine that with some of the fixed interest assets that you're talking about, they're a little bit more risky, and then an aggressive portion of the portfolio that's there to grow for future generations, we end up with this sort of really nice way of guaranteeing certain amounts of income, and then some assets that we can take out for single lump sum purchases like holidays or a new car or whatever that might be. So that's probably the one difference, is there are ways for people to forego future lump sums of capital and not have to worry so much about the compounding in order to receive a higher guaranteed income stream up front.
It's a pretty reasonable proposition.
Well, you never do it 100%.
Yeah, for sure. It's part of the portfolio.
Absolutely, right. And
with the amount, sorry, mate, with the amount that you allocate to those sort of products, be dictated to by the client's wealth, or is it more a case of how much certainty a given client really wants in their day-to-day lifestyle, and also what they can afford if the returns are a little bit lower?
A lot of it's about certainty. So we do sort of confidence testing on whether or not a client's portfolio is going to last the journey, and we always go above and beyond what the sort of standard moderate or comfortable lifestyle parts are. The saddest thing is when you hear someone talking about the fact that they don't think that they're going to have money when they're 80 or 85, and that's going to put them in a position where they're living a really awful lifestyle. But then because of that, in their 60s, when they choose to retire, they actually start living a really, really modest lifestyle from them to protect wealth for later. So giving that confidence situation is really, really important. No, one other thing is if we're in a situation where we're dealing with probably clients with sub $1 million in their assets, there is a benefit to putting money into some of these guaranteed income streams in terms of what sort of benefits they can receive on a social security basis. So the assets test reduction on annuities is really important. Once you put your money in there, the asset test for Centrelink purposes drops by 40%. So that might mean that you then go down to a level where you're able to access a healthcare card, so cheaper pharmaceuticals, all those sort of things. You might only get $20 a fortnight if you're just on the cusp, but that age pension will increase each year ever so slightly. It'll give you a little bit of inflation protection. And also, as we get sick, when we get older and need a little bit more medical assistance, not having to pay full ticket for the for whatever you buy over the counter at Chemist Warehouse is pretty handy.
It is. And you look, not something I'm super familiar with, but I'm sure if anyone's got any questions about just how that works, they can reach out to you. Dil, can I maybe wrap up today's podcast with sort of a final, maybe quick fire type round, and maybe you can fire a couple with me if that's of interest.
As long as it's lemonade related.
What are your kind of... It's always lemonade related, mate. We're always squeezing the lemon. Now, I wanted to maybe ask you 3 really quick sense checks for people to do if they're in that 60 to 70-year-old bracket. They're retired or thinking about retirement. what are the sort of 3 check boxes you'd like to see them make sure that they knock over in the next couple of years?
Yeah. Number one, how much do you believe that you need to live off when you stop working? So more often than not, when people come to see us, they have not thought about a specific number that they want in their bank account at the end of every month so that they can go and live the lifestyle that they want to. Number two, are you making the most of the last 10 years and making sure that you're moving all of your assets into a place where you can actually draw on that? And will you have enough from that to then draw the income? And number three is, are you taking into account the things that make you happy? Don't just take into account what you need to buy at the supermarket. Don't take into account the fact that the car needs a service every year. That stuff is a given. You need to pay for that stuff. But what is going to make you happier than anything? Because when we stop working, when we retire, there's a really good saying. It's we don't get old, we just get ripe. And when you're ripe, you're in the best years of your life, and you should be able to go out and spend money on the things that you really enjoy. Go out and spend time with your kids or your grandkids, or if you've got them, or go traveling if that's what your passion is, or buy the sports car that you've always wanted and drive down the Great Ocean Road. Like, do something that makes you happy, and make sure that you are allocating for that in that retirement budget. Can I ask you the same?
Really good tips. Really
Can I ask you the same questions? What's the maybe more from an investment point of view?
I'll go invest. Yeah, I think probably more from an investment point of view from my perspective. Number one is understand the difference between investing for a future versus investing when you're at that future that becomes today and that becomes the present, and how your strategy needs to change. Number two, a little bit what you're talking about, understand your lifestyle requirements and or desires and what they are. And if your assets are well in excess of what realistically you're going to need, we need to start thinking about, what the legacy of your years of success and hard work is going to start to do for other people. Now, that might be philanthropy, that might be helping your family members out. That might be helping me out. You never know. I could only hope. But I think having a concept that the money may last longer than you do is really important. And the third and final one, I think is relevant, is regardless of how you've made your money, what's worked for you, what hasn't worked for you, retirement throws up different challenges that you haven't faced before, and just to be open-minded in your approach to investing, be open-minded in your approach to advice, and to understand that this is a new phase in life. And whilst there's nothing new under the sun, it may not be the particular environment that you're really familiar with or have dealt with before. And certainly I can guarantee that you've never had a period in your life, particularly if you've been a business owner, where you're relying on someone else to pay your day-to-day living expenses, which is, generally fairly self-determined, from my client base. So it throws up some different challenges, and just to be open-minded in your approach.
What
to
happened
those challenges,
yesterday isn't necessarily what is going to happen tomorrow. Like we see new stuff happening all the time. Things change, and you've got to be ready for it, because in retirement there's no backup. It's all right, I'll go to work tomorrow and I'll get paid on Friday. It doesn't work like that. So just plan, basically. Just plan.
Look, agreed. I think planning's part of it. Execution's really important part of it as well, and getting it right. And then third and foremost, third and finally, I should say, it's making sure that execution can continue after maybe you're gone and your partner's still there, trying to live a lifestyle without you. So I think they're really important concepts we've touched on there at the end. And mate, as always, enjoyed our conversation today. And
yeah, it's been good today. It's
next week.
It's been great. I've enjoyed this. I a
little bit roundabout. Probably not as structured as I would like, but we're getting there slowly.
That's all right. I could talk about retirement till I'm retired.
That is not a good joke, Dylan. And on that, On that note, I'll see you next week, mate.
See you, brother. Bye.